This is scary. Listening to these pieces of advice could literally ruin your entire life.
We had $316,000 in capital losses.
My biggest loss was probably $1 million.
You are crazy if you think that the way you are going to get rich is from making the money that you have right now and just investing it in the stock market. That's insane.
We see bad investment advice everywhere, online, at work, during family dinners, and perhaps it is no more prevalent than on TikTok. Some of these videos I'm going to show today are perfect examples of the type of investing advice people need to avoid. In the engineering world, where my background lies, evidence and data drive all of the decisions. Same goes for medicine, a profession built on the scientific method. But in the investing world, folklore, gut feelings, and the loudest opinions often drown out the facts. Thanks for joining. I'm Justin, and today I'm bringing an evidence-based lens to some truly questionable investing takes. So with that, let's cue up video number 1.
We had $316,000 in capital losses. We were told that we could only deduct $3,000 a year on our taxes, but I did the math, and that would take 115 years, and I'm hoping I don't live that long. But our accountant said that he suggested opening a brokerage account instead of a 401k to utilize these capital losses, and I just wanted to hear your opinion on that.
Put the money into a mutual fund, and the problem is that if you put it in mutual funds, a lot of the gains may not be taxable because the growth in value is not taxable until you cash it out. What was this from? What's the loss from?
From trading. I'm doing trades.
Jesus.
Yeah, it was bad. It was a bad situation. My husband was diagnosed as being bipolar, but not until after this happened. I had just had a new baby. I was having problems with pregnancy, so he started working from home, trading, because he was doing it and doing well with it.
There's no such
up
thing.
Until he, up until he wasn't.
Yeah.
And so now it's just been trying to find.
78% of day traders lose money.
Yeah.
Statistically, that's called all of them. Okay?
Yeah.
So don't even ever say that again, that he was doing well.
No, never.
That's like saying I'm at the roulette table and I hit, so I'm doing well.
So 78% of day traders lose money. That's not trailing the market, that is losing money. So the percentage of day traders that trail the market is probably in the 90s. So definitely not a good way to make money. You're going to see a lot of people online teaching courses in how to make money in day trading. They make it seem easy and like a way that you can make a lot of money very easily and safely, and it is not. So I would absolutely steer clear of day trading. He also mentioned put things into a mutual fund. I've heard in the past Dave Ramsey say that costs don't matter in mutual funds and that you just find a fund manager that has outperformed the market in the past. But I have other videos, I'll leave links below, where I talk about persistence. Just because a fund manager has beaten the market for a certain period of time in the past does not mean that is going to continue. Costs absolutely matter, and keeping them low is really important. So I would not recommend a mutual fund unless it is a form of an index fund, so a passive investment with low cost. I prefer an all-in-one globally diversified equity ETF for the equity portion of your portfolio, or even a robo-advisor portfolio with a low fee, maybe 0.25 or at maximum 0.5%. Like I said, I've got other videos where I talk about that, so I'll leave some links below, but I would steer clear of actively managed mutual funds. Now, she also mentioned that her husband was diagnosed as bipolar. I have heard stories of this in the past. Oftentimes in households, one person looks after the investing, and when people age, they of course can develop different kinds of cognitive impairment. And when that happens to a person, they rarely actually realize it. So if they're handling the investment, especially trading stocks, which is super risky, really bad things can happen really quickly. So another good reason to have an advisor or a robo-advisor handling your portfolio. Now they have some advice from their accountant to open a brokerage account. I believe this would be a taxable account so that losses could be offset. But Dave doesn't really sound like an expert on how they can help recoup some of these losses. So if I was in his shoes, I would just advise them to get their own financial advisor who knows how the tax system works and can best help them offset the losses that they had. I should take the time to say, I'm not trying to give anyone advice here. I always recommend seeking your own financial advisor, definitely doing your own research, at the very least, your own due diligence. This video is just for education and entertainment.
So your
No,
husband
yeah, no.
being anywhere near a brokerage account sounds like suicide to me.
So that's what that is. A brokerage account is
A
similar
brokerage
to just
account
day
is an
trading.
account that you have with a broker that you call the broker and you do trades.
Okay.
Which
Okay.
is the answer is no. Your husband does
Yeah.
not need to be anywhere near that. I don't know in your household how you're going to create gains on investments to offset losses on investments to get the benefit of this that is substantial.
You call the broker and you do trades. Yeah, Dave's a little off here, respectfully. He is saying that you call a broker. I mean, there are online brokerages where you can do trades, but you can also buy a globally diversified index fund for you're not trading. Now, yes, the husband handling all this may be a bad idea, but they could get a robo-advisor to handle the money for them. They just put the money into that and then they're hands off. That's probably what I would say, but I wouldn't give them advice. I would tell them to seek their own financial advisor. Let me know in the comments some bad investment advice you've heard. And if you have any questions, let me know down there. And while you're at it, you might as well hit subscribe.
Let's talk the worst financial advice I have ever seen on TikTok. And now, guys, this is scary. Listening to these pieces of advice could literally ruin your entire life. The first one, and I just saw this last night and absolutely died. This creator was telling people that they could start investing with $0 by using credit cards, saying that you could start with one with a 0% promotional rate, meaning you don't pay any interest for 6 months. And she helps people do this all the time. This is criminal. I don't care that the credit card has a promo rate for 6 months. The real interest rate is going to be 20% or more, and you are not making that investing. Anyone talking about making returns over 10% is lying, or they're taking excessive risk, meaning they could lose all of their money or you could lose all of yours.
Okay, let's address number one there. So taking out a credit card and using that money to invest. Now, if it is a promotional rate for 6 months where you're not paying any interest, then that might make sense. But if you were investing it all in stocks, then you could very easily lose money. And then you would owe money on that credit card at the 6 month point when that 20% or so interest starts to kick in. And she's totally right. You're not going to make more than 20% reliably. So yeah, that sounds super risky. Now, if you were going to take the money from the credit card, the zero interest credit card, and invest that in something really safe, like maybe 5%, and then you pay off the credit card before the 20% or whatever it is interest kicks in, then that would maybe be something to consider. But I would have to look at that in more detail, and you'd have to be very careful, like I said. Don't invest it in equities, or not many equities anyway. Mostly something really safe like a high interest savings account. Okay, let's see what number 2 is.
Number 2 is investing into real estate in developing countries and expecting a 50% cash return annually. So say they invested $100,000, they're expecting $50,000 as the return every year. This is a scam.
Totally agree with that. I wouldn't expect a 50% return per year on anything. And yeah, emerging market real estate is definitely super volatile and risky.
Number 3 is that you should invest in startup companies or IPOs. An IPO is an initial public offering, and this is when a private company becomes public and allows its stock to be bought by regular investors for the first time. 96% are unsuccessful. Not only is investing in individual companies risky, but a company that has no history or track record, save your money to invest for something that'll actually make you money. We teach tried and tested strategies that help you buy the entire stock market.
There she goes promoting her course where they teach you how to buy the entire market. I can tell you how to do that really easily for free. I'll get into that a little bit later. But yeah, IPOs, super risky, even more risky than buying and selling individual stocks, which I don't recommend either. Yeah, a globally diversified index fund is what I recommend. And like I said, I'll talk about that a bit later.
Number 3 is that you can become a millionaire in a year. Unless you win the lottery, start a business that generates $1 million profit, or gamble and get really lucky, that's not happening. My climb to millionaire took almost a decade, and that's because I utilized leverage, aka other people's money, aka bank loans, to get an above average return. Now, you can become a millionaire in your lifetime. A lot of people have, and a lot of people will. Strategy is actually pretty simple, and it's something that we teach, but you need to invest to get there. You want to become a millionaire with less money? Invest, get started now, and let time do its thing. If you want to get rich faster, you have to put in more money or use leverage, but leverage can make things riskier.
Yeah, leverage makes things super risky. And I mean, in an ideal world for young people who don't have a lot of capital to invest, using leverage is probably a good idea to get more money into the market than they actually have. But the stock market is very risky, very volatile. And when you use leverage, it just amplifies the risk even more. So yeah, like in an ideal world, that's maybe what young investors should do. But realistically, how is their gut going to feel when their portfolio drops by 40 or 50% and they've borrowed money to fund it? AKA they're paying interest on the money that they put in there, which they are losing.
Number 4, that you should put all your money into crypto. Just don't do this. It's gambling. You wouldn't take your retirement savings and throw them down on black at the casino. Don't put that money into crypto.
Yes, I agree with the crypto take. It is super risky unless you really know crypto really well. And even then, it's speculation. I would not look at it as an investment.
Number 5 is using the equity in your home to invest. So imagine your home is worth $300,000 and it goes up in value to $400,000. You have $100,000 in equity. Some people, financial advisors included, telling everyday folks to take a loan against their house and use that money to invest. Many people treat this equity as free money when it's not. It's a loan against your home at a variable interest rate that is secured against your shelter, and that money only exists on paper.
Overall, I think her takes are pretty good. Using your home as leverage and pulling some money out to invest, yeah, that's another form of leverage and just amplifies the risk, especially if you're investing in something risky. And we have to take some risk in order to get a higher return. If we want to just invest in bonds, then over the long term, we're not going to see that much of a return, and we might not be able to meet our future consumption goals. So for most people, investing at least a portion of their portfolio in the stock market is a good idea. And I touched on it before. A globally diversified equity index fund is what I would recommend for most people. In fact, based on the data I've seen from Dalbar and other institutions, investors sabotage their own returns. And I've done some other videos on that. I'll leave some links below. But because investors sabotage their own returns and often trail the market significantly, that's why I say robo-advisors or a human advisor is the best way to go. Just try to keep those costs down. If it's a robo-advisor, 0.5% at the most, and a human advisor, you don't want to see much more than a 1% fee, depending on what they're doing. If it's overall financial planning and good investment advice, and they're investing you in index funds, then that is something certainly to consider.
You are crazy if you think that the way you are going to get rich is from making the money that you have right now and just investing it in the stock market. That's insane. Why? Because what you are actually doing is you're just letting other people get rich. Who gets really rich? The asset managers who manage your money, the banks that hold your capital. Why do they get rich instead of you? Because what do? They take your money and they do something with it proactively. So they take your money and they take real risk with it. Mm-hmm. And I think unless you take risk with your money, but also with yourself, you're never going to get wealthy. And so you and I could go very viral on the internet every single day if we talked about how to invest your first $10,000 to get to $100,000. Yeah. You could get a lot of views on that, except it's totally pointless. And if what we really want to do is elevate people to real wealth, where they have enough money for all the things that they want in life, it's not done through investing. It is done through earning. That is the only way you make real money. Once you make real money, you can make more of it through investing, but in the beginning, you got to earn. That's it.
So investing in the stock market, that is risk. That is more than enough risk for a lot of people if they are investing all of their money in the stock market. And if they're picking stocks, that's a lot of risk. That's a lot more risk than owning all of the stocks, or like 90 to 95% of the stocks in the world. And you can do that through a globally diversified equity index fund. And yes, you can get rich. You can build wealth over the long term investing in the stock market. I would say start investing as early as possible. When you're young and you don't have a lot of money to invest, of course, earning is very important. And so focusing on that, I can't disagree with either. And taking on real risk to pay for the things that people need, Okay, I mean, you have a small percentage chance of getting rich quick, but you don't have to take on more risk than the stock market to build long-term wealth. And with a good financial plan that an advisor can help you with, or a financial planner can help you with, you can meet your future consumption goals. So I would be wary whenever you hear someone say that you need to do something unconventional to cover your expenses and pay for the things that you really want, because those unconventional things are going to be most likely extremely risky. Okay, so the part about the banks that hold your money and the asset managers getting rich instead of you, she might have a point. I mean, if you are giving your money to someone who invests it for you and you're paying them like 1.5 or 2%, yeah, they're going to get rich if they're handling money from a lot of people, certainly because they are charging you a percentage of your money. But if you're keeping your costs really low, investing in the stock market is a really good way to get rich over the long term. I would diversify within that stock market. Again, globally diversified equity index fund with low costs. That way there is no asset manager getting rich off of your money. And if you're keeping your money in the bank, yes, they are making money off of your money, but we need to have some money in the bank for the day-to-day types of purchases. And what you don't need to cover your expenses, of course, you invest.
Let's talk about the 4 worst investments that I think you can make, and many of your friends or maybe people in your network might try to sell you on these. So number 1 is whole life insurance. There is something called term insurance that's actually pretty good. You pay a monthly premium every single month. It's a really low amount and you get a certain benefit coverage. So if you happen to unalive yourself, you get that benefit. Now with whole life insurance, what happens is your premiums are much higher and they go to funding what's called a cash value as well as your own benefit. And thirdly, they fund the salesperson. So if you're ever getting sold whole life insurance, it's usually not a good deal. They'll tell you that you can accrue this cash value and invest it, but traditionally it does pretty poorly. It only averages between 1 and 3.5% on your money.
Okay, yeah, so term life is the smartest move for most people. Now, I'm certainly not an expert, so again, I would seek your own financial advice from a professional, or at the very least do your own due diligence and a lot of research. But I personally have term insurance just because from what I've learned from reliable data-driven sources, term makes the most sense for most people, and for myself it certainly did.
Number 2 are triple leveraged funds. So there are such things as leveraged ETFs. And so when the index moves 1%, your triple leveraged fund will move 3% upwards. Some people think this is a really great way to make money quickly, but the problem is that if it ever goes down 1%, you're down 3%. And what's really fascinating is if the market is super volatile, you could still, the market could break even, but you could still lose money with a triple levered ETF or triple levered fund because it takes much more gain to break even on that loss.
Okay, so I have looked at leveraged ETFs, at least ones that gain leverage through covered calls. And they are typically a bad investment for the vast majority over the long term. They have high costs, which eat into your gains. And yes, so if it's triple leverage, your gains would, in the case of like a triple leveraged S&P 500 index fund, your gains would be theoretically 3 times higher than the S&P 500's gains. Your losses also would be 3 times that. But when you factor in the costs, you are not going to see 3 times the gains, but you are always going to see 3 times the losses. In fact, you'll see even more because of those costs, which are typically 2% or more. So that's a management expense ratio of 2% or more. And the way covered call ETFs are constructed, you don't actually realize all the gains in really strong markets. So over the long term, yeah, they are not good investments for the majority of people.
Number 3 is keeping your cash in a savings account that pays you less than like 0.5% APY. Right now, high yield savings accounts are paying 4.0 something percent APY. So as long as you are keeping your cash in a savings account, I think that's a really poor investment, especially if you can just move it to a high yield savings account.
Yeah, so I would certainly agree with that. If you can get a higher interest on your savings, then that's definitely a good idea. I don't really have much to add there. Let's see what number 4 is.
And lastly, I think the worst investment, number 4, would be loaded mutual funds. So these are mutual funds that financial advisors will try to sell you on, but they're called A shares. And with A shares, what that means is that your salesperson actually gets paid up front And then over time, yes, if you hold it for a very, very long time, those fees could make sense. But in general, for most people, it doesn't make sense. So those are the 4 worst investments.
Yep, so I don't know if those are all the 4 worst investments of all time, but certainly I agree with number 4, an A-series mutual fund. Yeah, and the advisor that's trying to sell you on that's probably not trying to sell you on it because he thinks it's going to be a good long-term investment for you. It's most likely because he is making a lot of money, a really good commission from that. And like Humphrey said in this video, the advisor gets paid up front. And so there are a lot of costs for the individual investor getting into funds like that. And the data shows that over the long term, the vast majority of those funds do not outperform the market, aka a globally diversified equity index fund.
Are you up all time on Shark Tank investments?
Nah, not. Am I up financially?
Yeah.
Oh no, I've gotten beat.
Really?
A couple.
What was your biggest loss?
My biggest loss was probably $1 million. There was this company that had would blow into it and it did alcohol detection, and it was a great idea and actually a decent product. But like the guy Charles, I look at his Instagram and he'd be in Bora Bora. And I look at his Instagram.
This guy's showing off.
Shit.
Yes.
What?
2 weeks later, and he'd be in Vegas partying, then he'd be on Nectar Island with Richard Branson. And I text him like, what the fuck are you doing? You're supposed to be working. Oh no, I'm networking. Next thing you know, all the money's gone.
Well, Mark Cuban can afford to lose $1 million, but most of us, that would be absolutely devastating and probably a lot more money than we actually have to lose. But that just outlines the risk of investing in a new business venture or just a single stock. If you don't take risk, you're not going to get reward, but that is a lot of risk, and your money could very easily vanish. So unless you're very well educated and an expert in business ventures, I probably wouldn't get into a new one. And that's the problem with investing in individual stocks as well, or these business ventures. You're basing a lot of money on maybe just one person, and that can be super risky. So in the case of stocks, when you invest in just one stock, your risk is very company specific. And that company's future, of course, depends greatly on the leader, the CEO. So if they start taking all of these vacations and saying they are networking and not really working, then you could lose a lot of money from your investment. And this just shows how investing in a new company is super risky. Investing in individual stocks is risky enough, but a brand new venture, super risky. Again, let me know in the comments any bad investment advice you've heard, or if you have any questions or requests for future video topics. Thanks for watching. Please subscribe if you haven't already. Share with anyone who might have liked this. If you liked it, a thumbs up would be awesome. And thanks for watching. I'll see you soon.